Sure. So the NPV this time around is 606 million. So an IRR of 106% versus 238 million last time of an IRR of 40%. That differential is explained by a few different things. So first of all, the increased throughput at the mill. So we're talking moving from 750 tons per day to 1,000 tons per day, and the output from 1 million pounds per year to 3 million pounds per year. Secondly, the increase in the uranium price, it was $70 last time around versus $100 this time around, somewhat offset by the change in the vanadium price, $12 last time to $9 this time. Also now we're including a number of mines. Last time we included 2 mines, just Shootering and Velvet Wood, and Slick Rock. This time we're including 6 of the 9 West Slope mines. And so that helped to kind of buttress the back end and contribute to kind of medium-term pounds being put through the mill. So all those things combined provided us the change in the upside. Yeah, I think the biggest thing is getting a better understanding as to what we're doing at site, further detailed engineering, hiring parties in-house. The last PEA contemplated kind of third-party contracting of a lot of the work to be done, but we've actually hired staff in-house, for example, an electrician, in order to deal with, electrifying the entire facility. So bringing a lot of that in-house and looking at detailed engineering helped to kind of mitigate the inflationary pressure between 2023 and 2026. Well, I think it's been very positive and been positively received, kind of a huge change from our last time to this time, the incorporation of all of these other spokes to our hub. The fact that the payback is very quick, I think is important. I think investors are comfortable seeing that there'll be funds generated in the relative near term, given that we're planning to start in about 1.5 years. So I think that makes it much more viable as an investment for, both equity and debt lenders. For the mill, we'll start with an anticipation of the radioactive materials license approval coming in the second half of the year. On the mine side, we'll be looking at JD8 permit approval. We expect to see that by the end of the year. We're also looking at SM18, one of the other West Slope properties that we've submitted essentially a drill permit for that asset. So hopefully get the drill permit, after which we'll submit a plan of operations for that asset, and expecting approval in kind of early 2027. And we'll be looking at the same for some of the other mines where we've done work, JD7, JD9. We'll be moving those towards plans of operations with the ultimate aim to have those ready for production, either prior to or just after the mill is ready to accept ore. For us, we'll be looking at, probably roughly $50 million in order to really reach that tipping point, in order to advance, the mines in the mill. A significant portion of that would go towards the mill, the uranium circuit, and the tailings pond. Those are the 2 key assets that we need to get in place before we really, can kind of get into production. Vanadium is something that we can add today or add in 12 months. It's not the big driver of the business. It's the uranium side that is the driver. And having the tailings pond, obviously a place to put the waste, is critical to production. So those are kind of be the things that we'll be focused on, along with some Capex associated with Velvet Wood and with Slick Rock. We've spent a fair amount on Velvet Wood already. We've advanced that mill pretty significantly. So the cost on that side is lower. Certainly there'll be some more work and monies that have to be put towards Slick Rock in order to bring that up to production status. I think from our perspective, the greatest concern for investors would be financing risk. That said, I think the numbers that we just shown are quite robust, and I think the market is quite excited by the prospect of our plan to put this into production. I think the financing risk is real because it's going to be larger than our current market cap in terms of the amount of funds that have to come in. That said, when we look at our peers on the production side, they trade at, call it 4 to 7 times our size of smaller peers. So we think that within the next 12 months, we can close a valuation gap as we continue to advance to production. I think the other kind of point that people are waiting for is the license approval. And so I think once the license approval is in place, it allows us to then start the refurbishment work and advance the assets to production. So I think looking at a couple of things, anticipating those those issues and those as hurdles, I think are what's kind of holding the market back today. But I think, we're very confident that these things will be addressed. The license approval is simply, it's not a question of if, it's a question of when. It's just timing. And the funding, between government funding for project financing, between third party, debt facility, facilitators, we have access or potential access to funding that's outside of equity. It's not just going to be, a dilution event that's going to be, double the market cap and the number of shares that we have. It's going to be more down to, securing the right project financing either through the government or through a third party, and pairing that with some kind of equity.